Warm welcome to everyone attending this webinar. Today we're going to spend about 40 minutes with me discussing global real estate and touching upon the current situation that we are into, a little bit changes in the portfolio and where we are right now, and hopefully some questions at the end of the seminar. Let's start with newcomers here. What is SKAGEN M2? Well, we are investing in listed global real estate with global exposure within basically all the subsegments. We have today 33 holdings. We tend to stick between 25 and 35, not to lose the diversification effect. Now we need a little bit more diversification, so we have put up the number at the top range of what we typically stick into. We have today, or not today, this year, a 10th year celebration. And we have delivered about 8% in euro to our clients annually since inception. We have daily liquidity, and we like to invest in companies with standing cash flow generating assets, but with some twist in terms of development, refurbishment, etc., that can enhance the rental growth more than the organic rental increases that we have. We also typically like a company with solid balance sheets and that are driven by long-term trends like aging population, digitalization, to mention a few. We have delivered about, as I said, 8% in euro terms since inception annually. We do, however, recommend that you will have a 5-year horizon. Since we are at the stock market, we think that is clever. This is a picture I always shows because I think it's important to know why real estate is a good idea and a listed real estate market is a good idea to invest within. I have framed two of them that are more important right now. I typically change these frames. All of these are important, but the frames I think catches the core at the moment. It's the total return concept, of course, that we always talk about, but more important today is probably the inflation protection. And the inflation protection I will talk a little bit more about later on in the presentation. Then we have the diversification, not only in different subsegments that have different drivers, of course, but also in geographical terms. But also worth to mention is the liquidity component that we hold in the portfolio, but also the flexibility that we can exploit undervalued subsegments or markets whenever we like. We're not stick to one market in particular nor segments. So I think that's worth highlighting. Well, we cannot have a presentation like this without touching upon the things that are currently happening around the world. Here we have the war in Europe. We have a severe COVID situation in China, for instance, with severe lockdowns, disrupting supply chains and hurting the economy. We, of course, nor I nor you listening to this know how this will end and when it will end. The only thing we can say is that it will have an impact on the economy. We have short-term impact. We have already seen that with inflation, staggering food prices, oil prices, etc. Besides from the humanitarian catastrophe, of course, but we also have long-term effect, and we don't know where this will end. Probably a clever conclusion is the closer to the war you are, the more severe hit you will have on the economy. We have seen this week the inverted yield curve in the US that typically indicates a coming recession next year and the year after that. And the worst case scenario, which some think and talk about, is stagflation, i.e. very high inflation with declining or low growth, which is the worst outcome. I'm not a believer of that scenario, but still, if that scenario would happen down the road, we would be mainly back to the 70s in a way, but all the crisis corrections has its own character and dynamics and logics at the stock market, so we cannot say how this will play out eventually. But in the 70s, which is interesting to do some sort of comparison with, we had wars. We had the Iran revolution, we had the Israeli war, we had high inflation, huge unemployment, and low economic growth. So for me, as a Swede and living in Sweden, I don't remember that, but I have read about it, and I know that we, during the stagflation years between 73 and 81, had about 10% inflation. We had a 1.5% growth, which was a really bad outcome, and we saw similar numbers in the US, a little bit lower in Germany, for instance. But according to a Swedish business paper, Dagens Industri, they have done a survey what worked best during this stagflation period. And actually it was construction and real estate that worked best. This is not, I'm not saying this is the thing that's gonna work coming years. But there is one component I want to lift, and I will lift it further down the road in this presentation, and that is the inflation-adjusted rents. That in some way protects the revenues and protect the cash flows and protect the valuation of the company. But you have opposing forces here, obviously, with interest rate and long-term bond yields. Central banks now are actually stuck between a rock and a hard place. We have this inflation versus financial stability. We have seen different experiments of this historically, where keeping the financial stability has won most of the times, and I hope and think this will win also this time, because unstable financial stability will create much worse problem than inflation, probably with huge unemployment, bankruptcy among companies, and very shaky banks. And we don't want to go that road again. So this means that the harsh and very aggressive rhetoric we can hear now from the central banks, we have heard it in the US, we heard it yesterday in Sweden, we have heard it from the ECB, etc. The purpose of that is basically to push down the inflation expectations, which is one part of the nominal interest rate. The other part is the real interest rate, and hopefully, and that's my belief, it will be kept low for a time going forward. And if that is the case, it's good for real estate, because inflation expectations you can always compensate for in the rents, but you cannot compensate for the real interest rates. One other good thing for real estate is that we don't experience any credit crisis currently, which we have done, for instance, in grand financial crisis. And this is important for real estate as being a capital-intensive asset class. But one has to be aware of the rising interest rates that we see, and be very aware of what type of companies you invest in and what type of credit lines they have and when they have to renew that. And also remember that many real estate companies has, during the non-inflation and low interest rate period, refinanced themselves on low levels and for a long-term period. We have also seen now the long-term, the long bond yields have started to have been actually moving upwards, especially in the US, has been 2.6 this week. Going up, and the market has been watching this and calibrating the levels for the 9 or 11 interest rate hikes that are in the cards, depends on what you believe, and also the following bond hikes that we have seen. Interestingly enough, this week the 10-year continued to climb to record levels, but the real estate market in the US also performed positive, especially yesterday and the day before, despite we seeing Nasdaq and S&P 500 decline. So probably this is a sign of they have found some sort of balance point for now anyway, on the information that was provided from the central banks and the protocol that was released also yesterday. Problem is just to find this type of balance points that always arises when you have crisis or you have big movements in interest rates in any direction. And typically also what you have seen now in both Brazil that started to hike last year and US that we have seen start to hike their interest rate path is that the real estate market is shaken initially, and then they find this point of balance, and then they move on and look forward. I don't know what will happen. I can only conclude that in SKAGEN M2 we have a solid portfolio, not only in terms of balance sheet, we do also have it in terms of subsegments and company that works in these subsegments. For instance, self-storage is a very good example. It has not much impact of the not affected that much by the economical development, rather people dying, moving, etc. For instance, in US, when you have bad economical or recessions, people has to move out and they have to store their stuff. So there are contrary facts here. But also we do have subsegments that are hitting the inflation instantly. Hotels, for instance, overnight, or self-storage, I can do it monthly anyway to catch the inflationary effect. So we believe we have a solid portfolio. The ones who have listened to me before know that we like this defensive growth kind of names that we see. Moving on, we start with last year. What happened last year on the big financial or the big real estate markets? US had its best year ever in history on the real estate market, driven by strong economy, driven by consumption stimulus, direct to consumer, etc. Nordic countries also had a very good run last year, especially Sweden. Europe hadn't opened up their economy, and they were standing on this verge of recovery and opening up now at the end of the year. And now was the time to recoup lost ground. 24th of February, the war broke out and Europe declined again, unfortunately. Asia Pacific was not even over the water surface last year and had actually a negative return. So first quarter this year, I already said Europe started extremely well but fell back. Even worse for the Scandinavian countries. Yesterday, Riksbank had they will start to hike interest rates earlier than expected. And that was basically no surprise because they can't stand against the rest of the world. US has also performed fairly well this year, but best of all is Asia Pacific. So if you're looking at this graph, SKAGEN M2 will probably never be at an extreme at any direction here, because we strive after having a good risk reward profile in our portfolio. And this is what you can see here. And this is also why I always talk about diversification, because if you invest in a specific country or a small market like Scandinavia, you live at that market, you have your real estate stocks, you probably have a house or something, or a summer house, you are very exposed to one single market. We look at the different subsegments. On the right side is the date where I had my last webinar. And then industrial was the prime, residential had a very strong performance, and also retail, much based on stimulus that we saw and the willingness to go out and meet people physically, and stimulus for cash checks and so forth. This year, so far, of the first quarter, it's almost the opposite. We have seen now hotels perform well and office is back. Office we have talked about before a lot, and we were a little bit early on that one. But if you remember, a couple of years ago, it was working from home. Everybody was doing that, and everybody was supposed to do that going forward as well. Then this changed suddenly to flexible work, and that was the future. And now it's more flexible back to the office. So the truth is probably that we will have some sort of flexibility, but people will go back to office, and people has gone back to office. And on the other end, industrial has performed less well after 2 years of being the best subsegments after these supply chain disruptions that we have seen, and an enormous growth. If you look at the valuation, this is aggregate net asset value or substance globally. So there are big differences still geographically and between the subsegments, even though it has contracted a bit. Market is trading at a long-term average, so nor expensive nor cheap. Depends on where, if you think net asset value will come up from demand and inflation, or if it will decline due to declining asset prices due to the interest rates. Cash flow is very important for value a real estate asset. This is the cash flow cash flow growth historically back to I think it's 2010, and also an estimate for this year. This is global and US listed real estate. Dark blue is global and light blue is US, and this is funds from operations, which you all know it's a cash flow measure. Last year was extremely well, strong economies, inflation started to take off, and this year the estimates are even better. How come? Well, of course, you have the inflationary impact. You still have a good impact from the reopenings. We should not forget that, from basically being closed markets to enjoying the effects from that. And there are some fiscal stimulus and also monetary stimulus still in place that gives us this effect. And also strong consumption, and we see in different subsegments, for instance, logistics, that are super strong demand still due to the supply chains effect that we saw during COVID and now during the after the war, and also this anti-globalism tendencies. You don't want to buy from China or whatever it might be. This makes disruptions in the supply chains, which is positive for this subsegment. On the other hand, we know that we will have increased interest rates. We will have these supply chains constraints hampering the economy. We have this geo and macro political turmoil that will affect economic growth one way or another, and already do. So my conclusion here is, and has always been as long as we have done these seminars, economic growth and job growth is important for especially commercial real estate, but also housing. And it's actually more important, I think, than the rates, or has been historically, and that's what I can lean on. But so far so good in terms of cash flow, and probably these cash flow numbers will keep up to being high due to the inflation, but will also come down a bit due to higher interest rates. So I want to show you a survey that was made in mid-March among people like me, asset manager, or people that are advising around real estate. 91% of these 54 respondents were on the managing listed global real estate or listed real estate, but the respondents came from all around the globe. They were asked, what is the most compelling driver of real estate that we are in right now in the current status? And 1/3 of all this, representing $350 billion US, said inflation. So why is inflation important? I will touch upon this a couple of minutes going forward and try to sort this out. For doing that, I think it's best to go back to square one. What is driving real estate value? Well, on top you have the rents or the income. And income or rents are driven by supply and demand, of course, GDP growth and inflation, vacancy rates, turnover-based retail rents, etc., etc. But the component here is inflation, which is typically found in most of the Western world in one way or another on the rents. In Sweden, for instance, it's reset every year, 1st of January. Last year, they added 1.8% to all the rents, which is, of course, there might be a mismatch here, but eventually it will catch up, right? So this is one of the most important components. But on the other side, you have the opponent here. It's the required rate of return, or the yield. And that's also based on growth expectations, opportunity cost of capital, risk premium. We saw that, for instance, in the countries adjacent to Ukraine, risk premium increased overnight when the war broke out on the risk of escalation. But the borrowing cost and the bond yields are, of course, a big component here. So in a perfect world, we have increasing rents due to strong economic growth, but low borrowing costs and low bond yields for real estate. But the point here is that we know that the yield will come up, but we also know that the inflation will come up. So it will compensate partly the value loss that we have from higher rate of returns. One example of this, how you can measure the hedge component in this, is to see the dividend growth. In this case, it's visualized by American listed real estate over 20 years. The light blue is CPI, i.e. inflation. So they are measured against each other. And in 2 cases out of 20, the dividend has been less than the inflation, and it's the grand financial crisis and it's the outbreak of COVID. In both those cases, many companies withdrew their dividend to save money within the company. But if you look at it long term, the dividend component typically compensate for the inflation over time. Also, if we see the operational cash flow and net operating income, it's the same pattern. In majority of cases, it's compensating, but it's the net operating income that fall down to dividends. So we went to the finish at the start here. Looking at the even longer history, we have seen this before. Now it's updated with a strong or a high inflation data point, and it's last year. So on the left side, you have the inflation in the US since 1972. Gray bars are high inflation, over 6.9%. Green bars are mid-inflation, 2.5 to 6.9%. And the white bars, as we have experienced over the last decade, is low inflation. So on the right side, you have listed real estate in the US with 2 colors. It's light blue, and that's the dividend or income return, and the blue bar is the capital raise or decline on the asset value due to higher interest rates or higher required rate of return. Also compared to the general benchmark S&P 500 here. So conclusion here over the last 50 years is high inflation is good for real estate, but mid inflation in absolute term is better. So if we end up with 2.5 to 6.9 in inflation next coming years, that is a good thing. So with that said, over the last 10 years, we have had the low interest rate, which has been beneficiary, but we have no beneficiary from the top line or the rent increases due to inflation, which we probably will have over the next years to come. Other things that is worth highlighting, which I have talked about before, that is positive with inflation, is if you have fixed debt, this will be absorbed by the inflation. Also a longer term effect, all the input prices and wages will come up and are coming up. We see that every day, which tend to lead to supply is coming off market because you can't calculate the profit of the project since everything becomes so expensive, which means that those that have the standing assets already in place will be beneficiary from this situation and eventually start to occupy their whatever it might be, their assets more and be able to hike the rents even further. And again, some sub-segments are direct beneficiary from inflation, hotels, self-storage, to mention a few. To sum this up, we still have good stimulus from reopenings and some stimulus also in the economy, driving fundamentals, but it's declining, of course. And let's see what's happening going forward. But this is still driving the fundamentals that we see now in most markets. And we have seen the markets calibrating these hiked interest rates and increased bond yields. And this means volatility. I think we will have that going forward as well. But for now, it seems a lot of these hikes are in the price already. The 3 main drivers and the most important components to keep a track on in real estate, demand, supply, and credit, are in good shape. With some exceptions, China is one of those exceptions. They're not out of the wood yet in terms of the credit part. Valuation is still dispersed that we have seen for a long term, but it's contracting, and it's a big difference between geographies especially, but also between subsegments. Inflation typically beneficiary for real estate, and that's also one of the beauty with real estate and the main characteristic for real estate and real assets for that sake. And we have also seen that through last year, where we have record volume transactions in Sweden, US, in many markets. And why is this? Well, number one, it was very cheap after COVID. A lot of prices went down, but investors started to position themselves for inflation, and this is important. The risk scenarios we have already talked about. Move over to the fund update. This is the portfolio as you have been seeing before. We started to use this picture in connection with the COVID breakout, just to illustrate the stability in the portfolio. On the right side, we have these resilient steady earners that are called defensive growth, self-storage, rental apartments, data center, self-storage, and those kind of names that are not as affected in every case on the economical growth or decline. On the other side, we have the recovery names, hotels, office, retail, and diversified, which has a bigger upside in the portfolio. First quarter, this is the contributors on the positive side on the left, negative on the right. On the positive note, we can see here a bit opposite what we saw last year. We have emerging market, we have office. Paramount, for instance, was one of the losers last year, but now is one of the winners due to a bid that came 1.5 months ago. And we have some diversified that are heavy within office, for instance. On the losing side, let's start to the right. We have a Dutch listed CTP. They have a couple of assets in Netherlands and also now in Germany after a big acquisition last year. But main asset base are in Czechoslovakia, Hungary, and Romania, and some other countries in former Eastern Europe. So basically, overnight, when a war broke out, they were punished for being so close to the war, and the fear of escalation put a wet blanket over that name. Self-storage group, Norway, familiar name, was one of top 5 winners during last year. And I'm a little bit surprised because this is a perfect holding to hold in this environment due to the inflation, the possibility to catch the inflation. And it's also a well-run company with a very strong owner backing this with Centerbridge, the private equity company, that actually increased the position not long ago to almost 30% or right below 30%. German residential is struggling due to interest rates increases, but also regulations that we have seen in the market. Problem here is a little bit that the inflation is not caught instantly in this segment due to the regulated rents. So investors have been a little bit reluctant on that, but names are still very strong and very undervalued. Moving over to what happened last year, we have talked about this before. We had 6 takeouts, which was very good. 4 full takeouts, 2 partial takeouts. This year we have seen already 1 bid. It's pending. We have seen a couple of other interesting events like Warehouse Depot, the big pan-European logistical operator, has taken a 10% position in Catena. We know that Heimstaden has a 15% stake in Kojamo. We have seen Centerbridge increasing in self-storage group, etc. So this is an important part of our management, the metrics that go outside of the pure real estate metrics. In terms of attribution, we have a good stock picking still, except from CTP in Netherlands due to the war, which has taken that green bar down a bit this year, but good stock picking in US and good allocation so far. Currency, the dark blue, we can't do that much about because we try to have a good balance to mitigate risk, but we're not speculating in currency. The ones listening to me before can notice that we have increased our position in US to 33% now versus 24% in September last year. We have increased during now the calibration on the US market, basically entered at good positions. We still have a far way to go to matching the benchmark at almost 60%, but we think this represents a better global portfolio and better risk-adjusted balance. We are also active managers, which means that we take active positions. Subsegments, not much to say. We're overweighted still logistic, residential, self-storage, increased a bit in hospitality, and diversified hides all the other segment basically. Top 10 position, there is some sort of new names has arisen here, but we still have a majority of within the defensive growth profile. It's 44% concentration, and we have an upside today of about 35%, which is conservative on these top 10 names, and they are getting cheaper as we speak, unfortunately, as I saw today. But interesting names and good to have in this environment that we are now. Solid balance sheets, we talk about that every time. We want to sleep good at night, and it's more important now than ever, I think, or anywhere for the last decade when we see interest rates hike, and we do want to have companies with solid balance sheet. Now our loan to value is 32%, which is obviously not a constant, the value part, but I think there is some sort of or a good cushion here if we see declining values in some assets. So what do we get buying M2? A new picture. We get price book of 1.3 instead of 1.6 at the benchmark. We get an earnings yield of 6.2% versus 5% of benchmark. LTV low, as we said. We have 75% small mid cap. We typically find the most interesting cases in that size. We have an active share of 87%, and now this year 10-year track record, which is very good. Over to a selection of new companies that we have invested in, and briefly about them. They are all US. Let's start with Sun Communities, very interesting company. It's today trading at a tad above net asset value, has been trading about 25% premium over the last 10 years, almost 30%. So we think we enter at very good levels here. This is a company of $21 billion market cap, so it's sizable. And they are actually in a niche segment that we've talked about before. It's manufactured housing. Basically, the company owns the land, either sell the houses or rent the houses to clients. And this is affordable housing. And this is important because affordable housing has been undersupplied in the US for a long time and also continues to be. And with amortization rates of reaching 5% in the US now, this affordability part will get even more important. They're also included in holiday parks, both in the US and recently in UK, which catches this recovery when people start to live a normal lives and travel and so forth. But they also have marinas, both where you can live on boats, but also you can put your boat there and they rent out the space. Very interesting. We also own UMH in the US doing basically the same. Another new company, Sunstone Hotel Investors. We have a small position. We are monitoring this part. It's high-end luxury hotels in the US. It has a market cap of $2.5 billion. So it's hotel and resorts. It's trading at 20% net asset value discount. We are looking at the RevPAR, or revenue per available room, and occupation are coming up and trending at the right direction. So I think there will be room for increasing this position, but also take up the target price as we see things are improving. So this is a normalization to normal earnings case, which is interesting. Last company is Hudson Pacific Properties. We bought into that last year as now a 2% position in the portfolio. Is trading about 35% discount to net asset value, and they have offices and studios, and it's studios to a fast-growing streaming industry like Netflix and the types. We like to have tenants in the portfolio that has a strong underlying operations and industry. In this case, it's streaming that is very strong currently. But another thing that's very important for us is that the companies within office that we buy into are sustainable or has a very strong path to sustainability. With that, I mean high-grade buildings, type A grade buildings, because we have now seen this very strong polarization between you have a green premium and a brown discount. And you don't want to sit in BC areas with not sustainable buildings because it will cost blood to transform them to sustainability and the requirements that tenants today have to be compliant on sustainability. So this is interesting, and Hudson Pacific Properties mainly present in or are present in on the West Coast in the US, and it's a very interesting company. So this is actually the Icon building, which is Netflix head office, and that's one of Hudson Pacific Properties assets. So here you have the studios, you have the office, etc. In the portfolio today, we have, as I said, about 20% office, and this is the names. And in the office portfolio, we typically try to buy these cheap names with potential. For instance, Hudson Pacific Properties trading at 1.2 times book. The real estate market in US are trading at 2.7%. Paramount Group is a New York-based office company, trading at 0.65, and the real estate market in the US are trading at 2.7. So basically, in all the markets that we're entering this type of assets, it's positive or undervalued. One thing is what you believe and think, another thing is fact. The black line here is the most important. This is supply and demand. And for the first time since 2018 in the States, there is more demand than supply on the office side. This has to do with the pandemic. Many break their supply because they didn't know if office were going to exist or not. But this is positive signs. There are cities with still some that struggles still. New York is one of them, but main gateway cities are actually positive. This is what we meet when we talk to meet people, read things. People are moving back to the offices, but it takes time. The last black strip here I took from Bloomberg yesterday. Bank of America will bring all US workers back to office by June 1st, vaccinated or unvaccinated. This is a good sign if you have or a landlord. Last page here. We talk about office. We talk about finding undervalued office. We have been good at it over the last 12 months. Paramount Group was the last bid in the portfolio. It's pending, so we don't know the outcome of it. Here we have that. Also, Columbia Property Trust was taken out last year by Allianz, also very undervalued. Starwood took out CA Immo last year, and we think this will continue to be the case because the valuation of office is still a pocket where you can find good value, among others. So with that, I will hand over to Ole Christian again, and thank you for taking the time to listen to me.
Mikael, thank you very much indeed for that update on SKAGEN M2. Now, I thought we should talk a bit about logistic properties. As you mentioned, they did really well during the pandemic, but from Q1, they haven't seemed to do as well. What has happened?
It's a good question. It's several things, actually. first of all, they had two tremendously good years, 20 and 21, due to the pandemic, increased e-commerce that pushed up the demand very, very strong. There is much growth expectations within some of these companies, so the valuations went sometimes a little bit too stretched, I think. Now it has come down and it's normal, I think, with higher bond yields, so they start to get more attractively priced now. And also this value versus growth rotation played a part as well in that. But with that said, it's super strong demand on this. If we looked at these record transactions that I was referring to before in many countries, for instance, the UK, most of that was actually within the industrial and light industrial and logistics, because we still see this e-commerce trend is very, very strong in total from all retail. And we see also manufacturers, companies leaving this just-in-time production to rather to be just in case, and this has to do with both in the Suez Channel, or it has to do with semiconductors not being delivered. It has to do with war, what will happen, will we trade with all the nations, etc., etc. So they're building up warehouses and fill them up to be able to produce. But also they're taking home production and they have to stay somewhere. And we also see new startups using warehouses actually to use as for plant factories or whatever it might be. So and also the defense industry are taking these now. So there is a huge demand. So we will continue to see growth even though we had a record year last year. And also Prologis that I have in the portfolio, the global and largest logistical player in the world, hit the record price level yesterday on the stock market. So we're back again on an interesting path.